Well, thank you, Tom, and thank you, Kallanish, for inviting me to speak today. I'm going to talk about the raw materials with a bit of a focus on China, looking especially on the steel iron ore side of things, a bit on met coal, and then finishing off on scrap as well. So it's certainly been an interesting year, extremely high prices so far this year for most commodities. But it's unusual that these prices absolutely not being driven by Chinese demand for once. This is not 2007-8, it's not 2010-11. We're not in an extremely strong Chinese demand environment. If anything, a lot of the latest data suggests Chinese demand is actually cooling quite significantly. Instead, prices are being driven by the ex-China demand recovery, post-COVID, post-lockdowns with all the stimulus. It's not just demand recovering, but of course, a great restocking cycle on top of that. And that is essentially what is supporting global prices. So steel prices, US, Europe, as you know, extremely high levels. That is essentially sucking steel out of China. So Chinese steel exports are very high, and that is what is providing the price support for both steel in China and therefore the raw materials, especially iron ore. So we don't believe the high prices are much to do with the China domestic situation. It's really about the surging steel exports from China, which of course linked into the very strong global demand. So certainly at the moment, it does look like steel demand is quite slow in China, and especially on the construction side. So the economy in China this year, Beijing's been flagging a slowdown since the end of last year. There's a 2% fiscal drag in the budget. There's 1.1 trillion less special bond issuance. That means less infrastructure spending. And of course, they've been tightening on the housing market for the last 9 months as well. So put all that together, and that backdrop is clearly not supportive for demand, especially for construction demand. So my view, since the end of last year, I was looking for China to have 5% plus steel production growth this year as exports recover. But I think from the domestic consumption side, we will see a lot of the consumption indicators being negative year on year in the second half of the year. Now, of course, through April, we've got very strong growth with the low base effect, but that numbers will certainly start to fade. And I think some of the indicators will be negative year on year in the second half. And in fact, from the construction side, when we look at China's rebar production, which we track on a weekly basis, that is now tracking not just down on last year, but also down on 2019. And you can see the trading volumes for rebar, wire rod as well recently have actually been well off their highs. So that demand in China, normally 2Q is a seasonally strong time, housing, infrastructure activity surging out of Chinese New Year through springtime into peak demand into kind of June before rainy season. This time around, you can see the trajectory on the rebar there has been quite mild. And like I say, we're now tracking down on both 2020 and 2019. Clear sign of weakness. At the same time, the steel inventory trends, initial view, they look quite in line with normal. But if you consider the backdrop of surging steel exports, then actually the draws in the inventory numbers onshore have not been that strong. When you look at the pricing at record highs, you'd imagine the inventory draw should be very sharp. We should be running out of steel if the demand was that strong and the pricing justified by domestic activity. But that's not the case. As I said before, the steel prices in China have more to do with that export demand. So we've seen a lot of volatility in Chinese steel prices and margins recently. Of course, Beijing has been voicing its frustration with high commodity prices and pressures, especially on the PPI, spreading to inflation. That's something they never like to see. So Beijing has clearly voiced its unhappiness against the inflationary pressures. And that has caused a lot of volatility in commodities recently. We certainly saw prices dropping quite sharply a couple of weeks ago. But of course, global prices, especially for steel, remain very elevated. So the domestic prices sold off initially, but they've actually seen quite a strong bounce because of that export demand. And that is what will support prices through the third quarter until global prices turn lower when the restocking cycle is finished. And that may well run through the end of the year. Chinese prices are very unlikely to go down, even with the backdrop of poor domestic demand, because that export arb is just so wide at the moment. So steel exports have already been surging, even with that backdrop of the reduction in the VAT rebates that was rumored since the end of last year. Steel exports still surging to 4-year highs in April. So last year, of course, with the world suffering COVID and China recovering strongly in the second quarter, China's net steel exports actually dropped to only 15 million tons last year. China was a huge steel importer in the second half, especially semis, as the rest of the world demand was struggling. But now we've seen a complete reversal of that. Chinese domestic demand is slowing, rest of the world is surging. And with the pricing action the way it is, that of course is encouraging more and more steel exports. So this is really the first cycle we've seen where exports from China are being driven by Western world demand, rather than, normally if Chinese exports are strong, it's a sign that China's domestic demand is weak. Chinese steel mills desperate to find alternative customers. This time it's more a demand pull story, with the strong ex-China steel demand, therefore supporting record high steel prices in China. The question is how unhappy is Beijing going to be with the steel exports? Of course, we've already seen the rebate removal, but actually that was a little bit on the weaker side than expected. Now, the rebate removal was first flagged in end of last year, but it didn't come until May. It took a long time, with obviously kind of steel mills lobbying that exports are still an important sales channel for them. So the reductions perhaps not as strong as some feared. Now, the latest rumors, of course, with Beijing trying to pressure domestic prices lower, is that they may introduce export taxes on steel. Now, that is quite possible, but the spreads are still $200-300 for many products. So even if they introduced export taxes at a kind of 10% rate, that would still be unlikely to dissuade exports in a major way. So steel exports are going to continue. I think Chinese steel exports will be annualizing well over 100 million tons a year in the third quarter. And that in turn, of course, is going to support Chinese steel production. So there's no way Chinese steel production will be down this year, purely on the base effect. We know first 4 months last year, China was very impacted by COVID, and that's why steel production year to date is up 14-15%. And at the same time, this year, we hear a lot of talk about closures, Hebei, Tangshan, etc. But those areas may be closing, but there is actually a lot of that capacity is just shifting to other provinces and to new steel mills. This is the biggest year of steel capacity additions in China ever, as the capacity swaps policy really comes to fruition. So yes, there's 100 million tons of furnaces closing this year, but there's over 120 million tons of new furnaces ramping up. About 30 million of that will be EAFs, and the rest blast furnaces. So China's steel capacity is actually growing this year, and with high steel prices and high margins, of course, the production is going to be growing as well. So that, of course, very supportive for raw materials demand, but iron ore supply is responding in the seaborne market to the high prices. We're seeing surging supply out of places like India, lots of juniors globally rushing back into the market that we haven't seen for many years. But the one notable absentee in terms of response to the high prices is the Chinese domestic mines. They used to be highly elastic in the early 2010s, lots of small private mines. These days, very inelastic supply domestically. The environmental pressures, the safety, the anti-corruption, licensing issues just mean it's very, very difficult for smaller private mines to really come into the market or raise production. And that's really limiting that ability of domestic supply to respond. So the supply we're seeing very much on the seaborne market and very much from the non-traditional supply end. You can see here the year-to-date shipment rates out of Australia, not up very much at all. There's hardly any capacity gain there. Brazil recovering strongly from last year's huge disruption, but even so, the recent numbers 2Q not up so strongly. And of course, with ex-China iron ore demand, steel production surging, then actually the arrivals into China in the second quarter have been quite weak. That in turn has meant the port inventory has been drawing a little bit in recent weeks. As I said before, the domestic supply has been quite disrupted recently. Had a lot of accidents, safety clampdowns, environmental clampdowns, all of those factors really limiting the ability of the domestic iron ore supply to recover. So the iron ore market overall, it's not as tight as it was through the second half of last year, but the tightness very much is falling in different products. So of course, with high steel margins, with the environmental pressures to reduce emissions, the Chinese steel mills absolutely eager to get the high quality raw materials. They want high grade ore, they want pellets, they want lumps. But of course, the recovery in ex-China steel production, those markets also disproportionately import a lot of those higher grade products. So all of the demand for iron ore today is at the higher end of town, whereas the supply growth coming out of India, coming out of the juniors, etc., is very much at the lower grade end of the iron ore spectrum. So that, of course, is manifesting itself in extremely high price premiums, both for lumps and pellets, but also the spread between high grade and low grade. So traditionally, we look at VIU metrics to judge, what's a fair premium and discount for high grade and low grade. But right now, with the surging steel margins, with the environmental pressures, those VIU relationships just breaking down a little bit. Could we be in a situation where the grade premiums and discounts remain at extremely elevated levels or widen even further through the second half of the year until global steel prices soften, allowing iron ore and everything else to come down? So that's it on the iron ore side of things. Certainly going to be sustained while steel prices and margins are sustained, even though there is actually some decent supply growth for iron ore. Just shifting on some of the other raw materials markets, met coal, obviously very much a two-tiered market with China's restrictions on Australian imports. You're seeing non-Australian met coal prices at extremely high levels, arbing into China at domestic levels up near $200, whereas the Australian price trading very much at a discount. Without China buying the premium met coal, China used to import about 30% of Australian export volumes, so that market very much in oversupply. But as we saw in February, in rainy season in Australia, as we've seen recently with BMA announcing increased maintenance and production shifts, as soon as there's slightly less spot offers, the met coal price is extremely volatile. So again, we're back up to $150, whereas we were barely over 100 a few weeks ago. So I think that's going to remain the case. As the supply, you've still got some increased met supply in Australia later this year, Anglo ramping up supply, others as well. So that could add more downward pressure on Australian met prices. Equally, a bit more disruption, a few more supply cuts out of BMA, perhaps prices could sustain at higher levels. So I think the met price out of Australia is likely to continue to be volatile in coming weeks and months. On the Chinese side, coke capacity absolutely increasing this year. Again, the capacity swaps issues, the end of the 5-year plan last year saw a lot of closures. This year, the new capacity finally being delivered. So we do expect onshore met markets to soften. And don't forget, even with China's environmentalism, coal output in China will still be growing in the current 5-year plan. China closed nearly 1 billion tons of coal mines in the last 5 years, but coal production over the next 5 years will be up about 200 million tons. Finally, just want to round off on scrap. So scrap, obviously with China's import ban, last couple of years, we've seen global scrap markets and Chinese onshore scrap markets trading at very different levels. But with China removing the import ban at the end of last year, that has allowed the seaborne price to essentially arb up to the Chinese onshore price. So yes, global scrap prices, of course, doing well because of the global steel recovery. But the fact China now has the option to import scrap means structurally, over coming years, ferrous scrap prices should stay at extremely high levels. And then if we throw on the potential for trade disruptions and export issues out of other regions, that could further boost scrap prices globally. So scrap is always, of course, linked into the iron ore price. It's been outperforming a bit, or underperforming rather, as iron ore surged this year. But I think structurally going forward, scrap prices will probably be the strongest of the raw materials, given that Chinese desperation for more imports, surging EAF capacity in China as well. So structurally longer term, China will have huge domestic scrap growth, reflecting the increase in scrap supply from the consumption that we saw in the 2000s, 2010s. But China will certainly still be chasing imports for the next 5 years at least, especially as their EAF capacity grows very strongly. So I think scrap has the brightest structural outlook of all of the raw materials. Iron ore should be softening as certainly as the Chinese scrap growth, of course, displaces a lot of iron ore consumption in China, while met coal longer term will remain more reliant on the growth in India, especially as the Chinese import market largely remains closed to the Australian coal. So hopefully some of those thoughts can spark a few questions in the Q&A session, and I look forward to discussing those shortly. Thank you.